It's lovely to be invited back. This is not my first Platform Leaders Conference. I've been here before, and it's wonderful to see it growing and changing, as indeed the market grows and changes. ISMR Capital is a generalist investor. We look at all things digital. However, platform businesses are a very, very important and additive part of that. I'd like to welcome to the stage two investment partners who have their own firms. And come on up, Camilla and Andrin. So these are two amazing people on the front lines of investing into digital tech. We're sitting exactly the opposite of our photos, but people will know who we are.
I think they can recognize us just about.
Exactly. Let's do that. What we'd like to do today is to have a bit of a discussion. So we'll make some comments and then open for more of a chat. Most of us invest in a wide range of business models and technologies, but we're going to focus a little bit on the platform type of business. But starting also with, we've been asked to give a little bit of the wider investment climate. But Andrin, can you tell us a little bit about yourself and Piton Capital?
Sure. So my name is Andrin Bachmann. I'm Swiss by background, and maybe to complete the European story, I'm probably one of the few people in this room who has 2 European passports, none of which are actually part of the European Union. So, I mean, you can guess what those are, but I now actually partially live in Amsterdam. So Piton Capital, the firm that I started about 15 years ago, is actually very focused on platform businesses, or we call them network effects businesses. And that's a focus that came out of experiences that both my co-founder Greg and I had prior to setting up Piton. And in my case, it was an involvement with a business called Allegro in Poland, which is really an amazing marketplace business that started as, if you will, the eBay of Poland and grew into much more than that. And I think it's a fantastic case study of how these businesses can become dominant when you focus on a particular market. And I guess it goes a little bit against the notion that you have to internationalize. It's a business that developed into a multi-billion market cap today from just really one market. But so at Piton, we invest typically at the early stages into businesses that we think have the potential to develop into network effects businesses. We've invested in between 50 and 60 companies now over the last 15 years. We're on our 4th fund at the moment, and very excited to see what the next wave of platforms and network effects businesses bring.
Well, we're going to come back to you for some specifics.
Good.
And this is not your first Platform Leader Conference either. So
it is actually the first conference, but of course I've very much known the.
Were we not on stage together a few years back? Marketplaces Connect.
Marketplaces Connect.
I'm getting old, but we've talked about this before. So today we're going to get some specifics of what's changed as well. But Camilla, tell us about yourself and EcoVentures.
Thank you, Joe. So I'm Camilla. I'm one of the founding partners of a new fund sort of backed by ISMR and a number of other fantastic institutions. And we focus on consumer technology businesses and enabling services with a focus on health and climate. And I know we're going to talk more about it, but we believe that those are 2 segments where there's huge opportunity to build the next wave of platform businesses. Health, as we all know, is 10% of global GDP, continues to grow, and there isn't a clear consumer or platform winner in that space at the moment. And climate is earmarked to be $1 trillion plus industry. We're starting to see early platforms like Tesla come through, but we believe every industry will have a player that wins with a sort of climate mentality behind it. My interest from sort of networks and platforms was really catalyzed from my time at a fund called Berda Principal Investments, something Francois knows well. They're the sort of owners of Immediate Media as well. And we were very early investors into platforms like Etsy, Vinted, not on the high street. And I still remember today Dr. Berda, who's the owner and CEO of that business, talking about the fact that the bedrock of successful businesses over time has always been connectivity and empowering individuals to build businesses on top of the business that you're building. And I think that sort of power holds true across every sort of platform shift. And there's a lot of exciting ones coming down the line.
Fantastic. Let's stay with you for a moment, if we can. I think everybody will understand what startup investing is and backing entrepreneurs, and you both do that quite early in their journey. There certainly are no profits. There may or may not be some revenues and so on. But can we make it a little bit concrete? Tell us one example, fairly recently, of a platform-style business that you've invested in, why you liked it, why you invested.
Yeah, definitely. So I think Joe's point around investing early sort of is a really important one. So we're really investing on the power of conviction that a founder has, so their vision for what the future looks like, and then our confidence in their ability to execute. So one of the businesses that we're most excited about is a business called Sourceful. So Sourceful was founded by two incredible individuals based in Manchester that had helped build out the Hut Group, which is a sort of major e-commerce player in the UK. Through that experience, they had identified that supply chains were absolutely broken, and they felt there was the opportunity to build a platform to enable people to more effectively build businesses and source both the packaging and then longer term the materials and the products that they needed to do that. The thing we were specifically excited about that is that they recognized the power that technology and artificial intelligence had to enable people to actually design the products on their platform and then understand what the reality of the manufacturing of that was, what the life cycle analysis associated with that would be, what the cost of that is, what the timelines is for that, and then link into the supply chains and actually enable the delivery of those products to happen. So they're building a sort of vertical end-to-end platform to enable people to design and manufacture anything that they want from their home and then build businesses on top of that. So that's a sort of recent example of a business we're sort of super excited about. It's growing really fast. We first invested in 2020. It's sort of gone on to raise 25 million sort of post that, and is working with lots of really great clients like Zoe and Wild and other fast-growing consumer brands.
Very interesting, thanks. And Andren, can you make it concrete for us with an example?
I'll try. If I may, I'll actually use one that's a little bit further back that I think illustrates a couple of themes along the way. And it's a business called Doc Planner, which we actually invested in out of our very first fund. And it's a business that started in Poland, essentially offering a directory of doctors in that market, in a market where there was no directory of specialists. So if you were referred to a cardiologist by your GP, you kind of had to go and find one by yourself. And what this business did essentially is to put together a directory with a recommendation platform attached to it, and essentially grew traffic very organically, and built what essentially was a dominant position in what you could describe as a TripAdvisor for doctors in that market. And that's when we invested. It was a very small business in terms of revenue at that point, but it had already built a really nice position with its initial product in that market. And so the bet at that point for us was that they could take that position and add additional value to both patients and doctors around that, and then internationalize. And I think it's been a tremendous journey to follow over the last 10 years or so, in that they essentially developed that into a full booking platform. Now it's becoming really an operating system for doctors. And they're now market leaders in about 7 markets in Europe and in Latin America. So it's a great example, I think, of a business that initially looked like a leader in a real niche market, but it managed to expand that into a really very strong position and a very valuable position in many more markets.
Very interesting. And both examples, as you say, start somewhere, but then find this customer value, and that's the network effect that we look for and hope to build. Couple of general questions, just to set the scene. So you find a great company you think can be big, you give them that initial money, And in 2020 and 2021, it seemed like money was everywhere, and you'd jump in a taxi and the guy would tell you about his startup. And you know, I think when your dentist is telling you about the startup, you know, we've reached a peak, and that's a real story. But here we are in 23, and we've had a bit of a washout in many markets, but certainly in this market. Give us a flavor for what's the entrepreneur encountering today, and maybe if I can give you both a two-part. First of all, when you go out as a company to raise your first money, what are the kinds of things that you need to show to have someone like you invest? And then if you can follow that with what would you expect to happen, so then they would get follow-on money either from you or another investor. Camilla, would you like to start?
Yeah, definitely. So it's a really great question, and I think it's something, it's very easy to put numbers on it, but I think at this stage, whether you're pre-seed, so raising your very first capital, or your Series A and raising a little bit later and you've got a little bit of traction, for us we think it comes back to the same core tenets. Are you as a founder resilient and optimistic about what the future looks like? And the reason that's so important for us is generally businesses change over time. So we're investing in you as a leader and your ability to be able to ride lots and lots of different dynamics. So if you take that example of 2020, we have a number of companies where they were sort of raising in a period of like gross optimism and there was money everywhere. And then they sort of hit COVID, things changed for a period of time, and then the market came back again, got even more exuberant, and then it totally crashed. During that time, we need that leader to be able to continually execute against the vision and the plan that they originally set out. And what we've learned is that really comes down to that founder having a vision of what the future looks like, and then not really allowing the market dynamics to get in to the way of that. So very early stage, it's about you as a leader and really anything you can do to evidence resiliency. So we run sort of psychometrics to try and understand that, do quite a lot of referencing. When we think about that graduation from pre-seed to seed and Series A, obviously metrics start to become important, but we're much more focused on, have you been able to like hire and retain really incredible talent? Are you able to articulate in a vision in a way that other stakeholders are coming along with you? And do we think you're moving towards building something that's going to create this compounding value and network effects rather than like chasing revenue today? And I think this downturn or this like change in market environment is really favoring entrepreneurs that are taking that long-term view, focusing on compounding and becoming a talent magnet for people that still want to build the companies of the future.
So can I just try to quantify that a tiny bit? So at the seed round where you're investing, you're really backing people and an idea. Do they have a product? Do they have a customer at that point?
So we back people very early. So they often adjust a team. They have an idea, but they might not have a fully built product.
Okay. And then the next funding, the A round, it doesn't always go straight to A, but let's say that it does. Then you want to have some metrics. So what have you got at that point, or KPIs you'd expect them to show?
So we still think it's about the key metric is the people. So we think that is really important. So can you attract and retain great talent? Underneath that, the specific metrics depend a little bit on your business model and how you funded it. If you're a direct-to-consumer brand at the moment, or an app business, you need to be in the 5 to 10 million revenue range. And then underneath that, you need to show some metrics very specifically around sort of consumer love. So do people love you? Is there a high word of mouth? Is there like high referral metrics? And in B2B businesses, you actually need to see something very similar. So are people like increasingly recommending your platform, and are they using you for more and more parts of your business, to your point around going cross-vertical and taking more and more of the sort of payment stack? So those are the sort of business models where we're seeing people raise Series A I guess in the sort of easiest way at the moment.
Okay, interesting. I want to turn to you, Andrew, and use that springboard, but I also want to pick out one term you coined, and you coined it as a negative thing, but gross optimism. I kind of like that. I think we all should have a bit of gross optimism. You certainly need it as a VC, but you said it as a bad thing, but I'm going to adopt it as a good thing.
It's definitely meant to be a positive thing. That's
gross
the UK
optimism.
mentality.
It's a good way to live. Andrew, using that same couple of questions, what are you expecting a business to look like? First money, second money, KPIs?
It's very hard to generalize. I think Camille mentioned that already. And I would say, maybe to take a step back, I think what we saw in 2021, of course, on the face of it, it looked great for entrepreneurs because money was easy. But at the end of the day, the entrepreneurs who really want to build something for the long term actually didn't really benefit from that very much, because at the same time as they were funded, 5 of their competitors were being funded by irrational capital. And so it probably kept markets that should concentrate around a winner competitive for much longer than was reasonable. And so I think we're in a very different environment now, and the founders who are resilient, who are focused on actually building real value for customers, I think are actually beneficiaries of a little bit more of a rational capital market environment. So I think we are increasingly focused on founders who also have an ability to get to profitability much earlier in the journey and are not reliant on venture capital, maybe in the way that people would have been in 2021. Of course, we hopefully can play a role as venture capitalists in getting to a point of profitability. But I think the times when you basically burn money for 10 years, frankly, are largely behind us. And I think that's a good thing.
Mm-hmm. And are you going to go on record with any KPIs you want to see for follow-on money? Or?
I'm really not, because I really think it depends. I think there are businesses, and I mean, clearly there are businesses where you want to wait with monetization until a little bit later on in the journey. I think kind of classifieds companies are great examples of that. You kind of know once you have critical mass in usage, there is a way, there's a kind of a well-proven playbook of how you're going to monetize that. So there it's much more around usage than it is about revenues. If you're building a more traditional SaaS company, of course, I mean, then kind of financial metrics probably matter a lot more. So yeah, as much as I'd love to have kind of a simple formula, I unfortunately don't think that's probably the right way to go about it.
I would love to have a simple formula that's something about network nodes or something. Once we, like, what is critical mass, right? Yeah. I wish we had a formula. The experts are telling me we don't.
What I would say is, I guess the way we think about it very often is there an initial, and almost a kind of a minimal viable market where you can play a dominant role in? To my earlier example around Doc Planner, I mean, at the time when we funded them, and that was literally a seed round of less than €1 million, I think, euros in total, they had already achieved essentially a market-leading position in their initial market. We love businesses where you have an ability to become a very strong, to develop a very strong market position in what looks like a niche market initially, and then branch out from there. Mm-hmm. And so then you can see metrics like actually already very high retention. You can probably see lower acquisition cost, for example, as you scale, which is kind of counterintuitive. Mm-hmm. Normally in a traditional business, you see increasing acquisition cost with kind of more scale. In network businesses, you see the opposite, right? And so we definitely look at indicators like that, but it comes back to how you think about your essentially market definition.
Yeah, interesting point. The other, you made me recall that one of the bad effects of overfunding in 2021 was funding lots of competitors that stayed alive longer than maybe normal market forces would keep them alive. But the other aspect that we saw a lot was overfunding can kill a company in the same way underfunding can. So you get too much money into a company because of gross optimism, and the team spends that money and has no operating metrics to show for and can't raise again, and they're gone. And I think we're in that moment of a little bit of shakeout happening now. But we had some good news this week in a platform business we're invested in, coming to your point, which is we have a plan for customer acquisition cost, and adding the new node is expensive. And what's happened in a beautiful way in this particular company, the repeat order rate from particular customers has shot up with 0 acquisition costs, and it drops straight to the bottom line. Remarkable, and it reminds me of the power of the platform. We didn't anticipate such a powerful reorder rate of existing customers, but wow, what a driver that's turning out to be. Last kind of general climate question. So here we are in 2023. You've got a good company. You're loving this team. They're building a good product. They're recruiting. All the things are going well. But you're not funding that company forever, right? You need follow-on capital. How is the environment now? What's that kind of company facing when they go out for more funding?
Yeah, it's a really great question. I think it's something everyone's thinking about. Our founders ask us about all of the time. I think if you're a company that has really strong network effects and you can evidence some of those sort of factors like the CAC coming down, the referral rate going up, really good sort of customer love or consumer love, whether it's B2B or on the consumer side, there is still capital out there to raise. So we have like one business that's in the market at the moment, as an example, that has all of those things. Super exciting business where every month we look at the numbers, we're slightly surprised. Like every time we sort of go out for dinner, someone mentions they're using this business. That's the business where, you know, it's received sort of 5 term sheets, highly oversubscribed round. So I think if you're in that bucket where you can really prove out network effects and you can get to profitability, it's hit profitability, then you're in a great place to raise capital. I think the companies that are struggling and where we're definitely having to spend some more time on is those businesses where there's not clear network effects or where there's a very high capex cost and that cost to capex has gone up because of the sort of interest rates and the cost of financing that. And on those ones, they're having to be more creative. So that can be working more closely with corporates and sort of partnering up around that. It can be rolling out slower so that they can sort of roll out. A lot of them have negative gross margins, so they can roll out in a slightly different shape. It can be thinking about how to transition to a platform model quicker. So as an example, we have one business that's growing really fast at a negative gross margin because of the space they're in, and they've switched on advertising early, and that's being a really positive 100% gross margin. So I think if you're in the bucket that it's not quite as clear on the unit economic side, then think about how you improve those unit economics quickly. And we're seeing creativity in a way that we just hadn't seen it 2 years. So I think those companies are going to come out stronger, more capital efficient.
Please make a note. Try to find a business with 100% gross margin. I mean, if you can do that, you'll be all right. You'll be all right. Yeah.
You'll be all right.
Yeah, it's amazing. They literally sent all of their customers an email, switched on the brands, and it's like it's just margin.
That's amazing. That's amazing. You know, I don't know how many of you are active in venture capital or not, but you both have used one word multiple times today that we never would have heard in 20 and 21, and that word is profitability. I mean, it's a fascinating. So you have 2 of Europe's top VCs on the stage focused on profitability, and I think that's really exciting because you're really building businesses that a lot of times the criticism of early stage tech is building a product nobody wants, or interesting tech but no market need or whatever. And it's fascinating to hear you talk about. Actually, we got our eyes on that profitability prize. Long may that exist. My experience is in the up round, in the really gross optimism side, that talk goes away and it's funding at all costs. But let's turn from...
But actually, may I just kind of follow up on that? I think I would say that for the late stage rounds, you have a brutally bifurcated market now. And I think that's kind of what you're alluding to as well, Camilla. I think the risk is that a bunch of the late stage investors are becoming quite formulaic in how they think about businesses. And of course, if you have a SaaS business with 90% gross margin, 70% growth, kind of extremely high net revenue retention, that's easy to fund. I think the slightly more subtle stories, in some cases, stories that ultimately I think will be very valuable businesses, are actually harder to fund even in this environment. So that's what I worry about. I think there's the easy cases, and they should obviously get money. And there's also the easy cases on the bad side that obviously shouldn't get funded. But there are, I think, a few companies probably in between that are at risk of not getting the capital they deserve, because I would definitely observe a trend with some of the later stage funds becoming very, very formulaic in how they think about.
We've certainly seen a return to conservatism, and that's a form of it.
It's a form of it. I think it's also a form of some of these firms having become extremely institutional. and probably in some cases people with relatively limited company building experience making decisions, or at least being involved in those processes, and I think that can be very problematic.
Right. In your view, can they access the capital, but access it at a very different sort of price, or can they just not access it at all?
I think the risk is they can't access it at all, actually. I think to your point, some companies, I think what we see is some companies get as many term sheets as they want at pretty attractive prices, and some just simply don't get the interest. So I do think it's a very bifurcated market in that sense.
Interesting. So I have a lot of questions, but I don't want to dominate. What I would suggest, if you have a question, join in. You can do that now, or oh, we have one already.
Hi. So with these network companies, obviously you're placing a bet on the future, right? It's a lot of the value of these companies resides in the user base, and how effective they are able to kind of capitalize on the total addressable market. So I guess my question is, you know, when an entrepreneur pitches to you, like, you know, this is the total addressable market for what we're doing, we're going to capture X% of it in 2 years. Like, how do you go about assessing the credibility of those claims, right? Both in terms of the size of the market, but also the pace or the skill at which they can get there.
Yeah, definitely. So it's a really good question, and we do market mapping. We do all the traditional things. We sort of build the market bottom up, and we do sort of quite a lot of referencing call with industry experts. But I think my number one learning from my time in venture capital is believe the entrepreneur and their vision for where the market's going. They're generally smarter than you. And I'll give you a very concrete example of that. So one of our earliest investments was a business called Gusto. Anyone that's been on the tube might have seen it. It's a sort of online grocery player. So we invested in that business when it was doing 10 or 20,000 of revenue. And at the time, that whole market was less than 100 million. They were a very high price point, so that would have shrunk that market even more. You could look at how much people in the UK were spending on grocery. And I remember having the conversation with Timo, and I was like, your market just isn't that big. You can't build a big business in this space. And Timo was like, no, like grocery is this size, and then you've got leisure, and you've got this, and you can take all of these different spend buckets. He's right, I was wrong. He emailed me about 18 months ago, or WhatsApped me, and was like, hey, just to let you know, I'm significantly bigger than your maximum market size. And I think that's true. Like, trust entrepreneurs. They have a vision that's normally beyond where we are as investors.
But part of that, I think what you're pointing out is there a market you can calculate, or is this innovation creating a new market? You see that pretty often with tech innovations in particular. Any other thoughts before these are two people I love talking to, so if you let me, I'll still be here in 2 hours with my questions, but feel free to join. Question here?
Can I ask both Camilla and Andrew, at what point do you invest in a company? What's your smallest investment? Where do you kind of start?
So we go small sometimes, and small for us would probably mean in the hundreds of thousands. Our typical check is in the low millions. We go small. I would say maybe different to Camilla. We tend not to do pre-product investments. We quite like an entrepreneur maybe having worked through some of the initial kind of product questions, maybe having figured something out in a small part of the market already. So we're less focused on revenue there, more on usage, but we typically invest kind of post-product, I would say.
Thank you. Camilla?
So we invest from pre-seed, so that's a really good team with a sort of idea in a market we're excited about, all the way up to Series A, so that's where you have a few more metrics. And those are normally businesses where we've tracked over time, and there might have been a reason we didn't initially invest, and then the metrics have come through and we've been lucky enough to join.
Thank you.
Any other thoughts, questions? Oh, one more in the back.
Specifically to Camilla, you mentioned about investing in climate businesses, and I was wondering how you see that in your list of metrics and what you're looking at in terms of that, potentially with a platform theme as we're here as well.
Yeah, 100%. It's a sort of great question. So we invest at an overall level in something we call commercial impact. And underneath that, we have the specific sort of thesis around shared value. So that's the companies are creating both commercial value in tandem with a sort of social climate or a health sort of goal. So with Gusto, the example there is they use data science to very significantly change the margin structure in food by reducing waste and increasing customization. That both increases the customer sort of improvement, but also takes 30% of the food waste out. So that would be a sort of example of like shared value. How we think about it from a platform perspective is we're looking for companies where the core driver of their business also leads to the sort of climate output. So an example of that would be we have a business called Foresight Data Machines, which is trying to build the operating system for steel plants to help them decarbonize the steel plant. They started to this point about sort of solving narrow problems. They started with like a very tiny like software problem, which was optimizing temperature and blast in electric arc furnaces. That technology, they realized, actually had like a much bigger application that could have commercial value quicker by helping people buy scrap at a lower cost and introducing new sort of materials. So the vision is the operating system. That has a clear sort of decarbonization climate benefit, but then they start with sort of modules underneath it. So those are the types of models we're looking for in the climate space. We don't currently invest in sort of carbon capture or some of the sort of more like infrastructure-led players. We're very much looking at the players that are trying to like shift supply chains into the sort of decarbonized future.
What I'd like to know, and we will have a little more time, we're still on track. I'd love to know, Andrin, you're one of the first people who explained to me about marketplace businesses and multi-sided businesses a long time ago now. Question to both of you about the platform companies you've invested in. Is there anything different today than say 5 years ago and 10 years ago? Any key trends you're seeing that have changed your thinking from how you were investing, 5 and 10 years ago?
I mean, I would say the beauty of these businesses is that the core concept remains intact. It's fundamentally, network effects are as old as, almost as humanity, right? I mean, it's just a very natural construct to bring together, whether it's supply or demand, whether it's communication systems. It's a very natural, almost biological construct. But of course, the technologies that you can access change over time, and so you have to adapt. And I would say, since we started, we started the firm basically as mobile became kind of one of the dominant computing platforms. That had an initial impact primarily on the consumer space. And so if you look at our investments in our first fund, they were very consumer-centric. I think more recently, that has started to also permeate the B2B space. So we have a lot more that is now B2B-centric. I guess the big question going forward now is AI kind of a similar shift, right? What are the threats and the opportunities to these models from AI? And that's definitely something that we spend a lot of time thinking about right now, because I think it will be pretty significant in many ways, which if we do have time, I'm happy to talk about.
Yeah, this is an interesting, I'm hearing you, and we all think about the early models, the eBays and so on, aggregating buyers and sellers, but some recent things you've done in the shipping sector, really old industries that are now able to apply these forms and logics and off-the-shelf tech. I mean,
right.
There isn't new tech there. Camilla, what do you think?
I think very similar to Andrew. Like AI is obviously topic of conversation for sort of everyone. I think how we see that is very similar to mobile in that it's an enabler to supercharge platform and marketplace businesses rather than being a business model in itself. That's definitely what we're seeing across the portfolio. And I think the really exciting part about that is it enables people to build platforms where other people can build businesses on top of it quicker, and it allows people to move that sort of idea or like theory of creativity they have into a physical reality. So one of the spaces we're really interested in is how you start to enable like more crossover on, we sort of call it the biology like hard side with the marketplace side. So if you've got a new product, suddenly you can like design a new material for that product rather than sort of just design like improve the branding and then sort of put it on an existing product. So we think there is going to be a wave of platforms enabled by AI that allow more creativity in the sort of material space. So that's definitely one of the sort of platform themes we're like excited about.
I guess one of the things I'm not clear on yet is to what extent AI will change the demand side of the equation, the way mobile has, which basically was a different interface for consumers. And so I guess that's one of the, for me, the open questions. And the other one is to what extent and where is AI essentially a sustaining technology versus a disruptive one, right? And I think the argument is that in some areas it will likely favor the incumbents who are sitting on top of data, because the value with AI is clearly going to be more in the data than in the code. And on the flip side, obviously the barrier to starting a business has just kind of been lowered once again, because everybody now can basically build software. So I think it's going to be a very interesting tension between those two concepts. And my guess is, yeah, actually essentially trying to innovate in areas where companies have not yet successfully digitized, and therefore there isn't a digital incumbent, is probably a fantastic opportunity for the next 5 or 10 years. I think you talked about health. That's a great example, right? Health is an industry that's still essentially in the dark ages as far as digitization goes for the most part. Real estate is another one, right? It's just extremely big, but extremely analog. Shipping, which is an area that we have an investment in, is a great example. And these take time to build, because you're basically digitizing very old school and in some cases very fragmented industries. But the value that comes out of that, I think, is potentially gigantic.
Yeah, really interesting point about, you know, AI is moving quite quickly from this magical unknown thing that only certain people can access to. In our own portfolio, we have tons of people building the tools that will enable all of us in our companies, in our homes, whatever. So it'll kind of be commoditized. As you say, the code is cheap. Auto coders and pre-built components that you plug together. So you can, it's not that far away where that's just a way you do things, and therefore the data owners have the power at that point. It's kind of an interesting point. We have one more question or one more minute.
Can we take a question from the chat, please? Because it's relevant. David online is asking, what are the best metrics that AI digital platforms should be focused on? Is it different for AI versus you know, what you've seen around the focus on profitability? Are they in a different space, or is it the same metrics?
Anyone have a thought on that?
Look, I mean, the cynic in me says, I think, I'm not sure there is such a thing as an AI platform. I mean, there are obviously pure play AI platforms, but I think AI is much more, I think you made this point, Camilla, as well, it's much more of a technology that I think every business will be an AI business, and it already is. I mean, we see it across the portfolio and across the industry. So I think, I mean, a lot of entrepreneurs understandably are trying to use the AI hype to, I guess, attract attention from VCs, and to some extent they're successful in doing so. But I'm not sure that is where, I guess, my interest lies, frankly. I think I'm much more interested in how, yeah, this will actually impact the economy and the businesses that we invest in, not for the next 12 months and their funding journey, but what they will look like in the next 5 or 10 years.
So I think about it like you. AI is like a spreadsheet. It's not the business. It's how you run the business, how you improve the business. Unless you're the maker of the spreadsheet, and there are a bunch of those. So Microsoft Excel makes a lot of money. So there are a number of companies doing that. But I think that's our time, unless anyone has a burning last question or anything in the chat.
There is another question in the chat if you've got time.
We can take it real quick.
Just the impact of regulation, has that changed your approach to
That's not real quick.
That's not real quick.
It's not quick.
It's quick to ask.
Oh,
I think it's a big one for AI, actually. I think one of the concerns, real concerns I have is regulatory capture. And frankly, I think it's very much going the wrong way right now. I think, without getting into politics, I think the executive order in the US last week, that's a classic case of regulatory capture in my view, and it's just benefiting the incumbents. So I worry that we're seeing very legitimate concerns about AI safety being hijacked for the purpose of essentially stifling innovation.
Yeah, I definitely agree with that. That's what we're hearing in the health space, which is like heavily regulated, and a lot of the innovation has been around sort of AI-enabled like tooling, which is less regulated, and we're starting to hear people in pitches be like, there's a 1-year window for us to like get through the regulation because this regulation's coming, and once it comes, no one's going to be able to get through the door. And I think we find that pretty disconcerting that that's like the mentality that's starting to happen because of the drive on regulation.
Well, I want to end on a
Positive,
optimistic note. After that slightly, I'm sticking with growth optimism. One of our VC partners has been seconded to the Prime Minister's working group on regulating a number of things to do with AI. And he's just in the last few days said at one of the summits with lots of governmental important people, said, I'm surprised how much we agree. So they expected to hash it out over a long period of time. And he was saying, actually, we're kind of closer to each other in ideology than we thought, and that's a way forward. It's not a result, but it smells good so far. So thank you so much to my all-star panel.
Thank you.